You've got money to invest, you're thinking long term, and you're faced with a big question. Do you put your capital into the stock market or into real estate? Both can build wealth, but they do it in very different ways. Stocks offer speed, access, liquidity, but they're also volatile, and that can keep you up at night. Real estate moves slower, but it's built on something tangible: property, income, long-term control. If you're looking for more consistency, more control, more predictability, real estate, especially passive strategies, might offer the edge you're looking for. Let's dig into how both approaches actually work. When you invest in stocks, you're buying ownership in a publicly traded company. Your return depends on how that company performs and how the market feels about it. Stock values can swing based on earnings, interest rates, global headlines, even social media. Some people go for long-term buy and hold. Others swing trades or chase short-term momentum. Dividend investing is popular too, but most yields range between 1% and 4%. Let's talk about real estate now. With real estate, you're investing in physical property. That might be residential units, apartments, commercial assets like shopping centers. You earn through cash flow, appreciation, and tax benefits, and you don't have to be a landlord. Thanks to passive options like syndications, REITs, and crowdfunding, more people can access real estate without managing tenants themselves. Let's compare some key differences. Volatility. The stock market is highly volatile. Prices change daily. Real estate's more stable. It moves slower and is tied to local economic fundamentals, not the headlines. Cash flow. Stocks offer limited income through dividends. Real estate can provide 6 to even up to 12% in rental income annually. Control. With stocks, you have zero operational input. With real estate, you can choose your deals, your markets, your strategy. Taxes. Stocks offer very few tax breaks outside of retirement accounts. Real estate offers depreciation, write-offs, 1031 exchanges to defer capital gains. Inflation protection. Stocks are a moderate hedge. Real estate is a strong hedge. As inflation rises, so do rents and so do property values. Let me show you how this plays out. Let's say an investor invests $100,000 into a stock index fund. Let's say it earns 7% a year over 10 years. That's about $197,000 before taxes. Now, the investor invests the same $100,000 in a passive real estate syndication. The deal produces 8% annual cash flow and 5% appreciation. Over 10 years, the investor earns $80,000 in income and sees the asset grow by $63,000, $143,000 in total returns, many of which are tax advantage. So while the investor gets more on paper, he gets paid along the way with less volatility. And depending on tax treatment, the investor might keep more. Now, why does this matter for beginners? Because when you're just starting out, you want stable income, predictable growth, and protection from market swings. Real estate delivers all three, and passive investing makes it more accessible than ever. You don't have to find tenants, fix roofs. You can invest alongside experienced sponsors, receive quarterly distributions, and let the asset work for you. Here are 5 reasons real estate's a powerful long-term strategy. Number 1, you get paid while you hold the asset. Real estate produces income from day one. Stocks, you often have to sell to realize gains. Number 2, you can improve the asset. You can increase income through renovations, leasing, better management. You can't add value to a stock. Number 3, real estate performs well during inflation. As the cost of living rises, so does rent, helping you preserve purchasing power. Number 4, you benefit from tax advantages. Depreciation and 1031 exchanges help reduce or defer your tax burden. Number 5, real estate is tangible and understandable. We can see it, walk it, improve it. It's not just numbers on a screen. Of course there are trade-offs. Real estate's less liquid. It requires more upfront capital, and choosing the right market, asset class, and sponsor team is critical. But for long-term investors looking for income and resilience, real estate might offer the kind of calm, steady growth that the stock market can't always promise. So what should you do next? Here's your checklist. Number 1, clarify your goals. Are you looking for growth, income, or both? What's your time horizon? Number 2, decide your risk tolerance. Can you stomach the big swings, or do you just want more stability? Number 3, diversify. It's not stocks or real estate. Many savvy investors do both. If you're going into real estate passively, choose a solid sponsor with experience. Also, understand deal structure, the fees, the exit strategy. Understand the market fundamentals, the location, tenant demand, economic drivers. If you're going into stocks, try using index funds or diversified portfolios unless you're doing deep research on each company you want to invest in. Know how your dividends, valuation, and market cycles work. Keep your horizon long term. Don't chase quick flips unless you know what you're doing. Real estate and equities both reward patience. If you're new to investing and you want to dig deeper into how retail real estate works, how passive deals work, how value's created, what the underwriting looks like, visit our Learning Center. Subscribe to our YouTube channel for more breakdowns and real-world examples. Invest with clarity, invest with purpose, and invest on ground on which you can stand.